Last in, first out. Last in, first out is also known as LIFO. Last in, first out or LIFO is a method of inventory valuation for accounting purposes with the accounting assumption that the most recently received, that is last in, is the first to be used or sold for the costing purposes. But there is no necessary relationship with the actual physical movement of goods. In other words, goods may not move in the order of last in, first out, but the cost of goods is calculated with the assumption that the latest goods are consumed. As you see in the diagram, you will keep purchasing the items at one end. There are sequence of goods entry in chronological order of entry. However, when you issue the items, the order in which goods are perceived to be issued is reversed. In the diagram, fourth lot will be issued first. Third, second and first lots will follow for later issues of inventory. As mentioned earlier, latest goods received are assumed to be issued first for costing purposes in LIFO valuation method. Every issue or cost of goods sold are valued at the cost of latest stock purchased. The remaining stock is valued at the cost it was received at, assuming the oldest stock is that left in the stores. If you are living in the inflation environment, there is impact on values with LIFO valuation in place. With LIFO valuation adopted, cost of goods sold and cash flow are increased. Whereas your profits calculated according to valuation based on LIFO will be lower. For this reason, cost of goods sold are valuated at the latest price, which will be lesser compared to the older price in inflation environment. An example scenario will make it more clear on how LIFO valuation works. Given table provides an idea on how LIFO based valuation happens for inventory of certain item. On 1st January, you have a stock of 200 units which were purchased at a unit price of $2. Total cost of inventory is hence $400. On 15 January, you issued 100 units to production floor. Cost of goods is calculated at a price of items purchased on 1st Jan. Hence, cost of goods issued will be $200. Balance will be 100 units at a cost of $200. In the course of time, at the end of month January, unit price of item is increased to $2.1. So you purchase 400 units at higher price of $2.1. These 400 units purchased are included in your inventory along with 100 units already in stores. These 100 units are however purchased at a price of $2. Your inventory balance of 500 units is combination of 100 units at older unit price of $2 and 400 units at latest unit price of $2.1. Total inventory value is $1,040. Now you issued 100 units on 11th February. Irrespective of what goods you issued from the stock of 500 units, the cost of issued goods will be first valued at the latest price. Hence, the cost of goods issued will be 100 units at a unit price of $2.1, which will be totaling to $210. Now, you have a balance of 300 units purchased at $2.1 and 100 units purchased at old price of $2. Total inventory value will be $830. On 17th February, you issued 300 units to production floors. For goods issued on this date, the cost of goods issued is valued at the latest price of goods in stores. As you are holding 300 units at this price, all these goods are issued at a price of $2.1. Balance remains 100 units purchased at older unit price of $2. So, inventory balance will be $200. Now, price is further increased at the end of February to unit price of $2.2. You purchased 400 units at this price. Your stock will hence have 400 units purchased at a latest unit price of $2.2 along with 100 units of goods purchased at unit price of $2. The inventory balance on 29th February is 500 units at a total cost of $1,080. On 9th March, you issued 300 units of item. By now, we know the cost of these items will be valued at a unit price of latest price, that is $2.2. Hence, the cost of goods sold will be $660. Your inventory balance will read 100 units at a unit price of $2.2 and another 100 units at a unit price of $2. Balance will be $420. If you buy further 400 units at a higher unit price of $2.25 on 13th March, that stock will be added to inventory. This stock of 400 units at a latest price is lined up for further issues to production floor or for sales. You notice that the first lot of 100 units purchased at a unit price of $2 remained idle. After some time, some more stock purchased at $2.1 is added to remain idle. To avoid such situation, you need to have controlled purchases and quick issue of goods for sale or for internal use. This way of calculation continues in the same method. We will discuss pros and cons of LIFO method. LIFO is beneficial for those wanting to keep the tax cost at lowest level. The reason is because in inflation environment, latest prices are high, hence cost of goods sold are also high. Because profit calculation results in low values, the tax will be less. This method works well for organizations which sell fast-moving items. Typical retail firms who want to work with trends and quickly sell items that are in fashion now get benefited by adopting LIFO valuation. Similarly, chain markets who deal with fluctuating prices of food and other perishable items prefer to have this inventory valuation method. According to LIFO principle, even if you are issuing the latest goods first, still gain when you are able to sell the older stocks quickly. This is possible only when the older stock don't lose their looks and characteristics. There are, however, many negatives with this method. You may be benefiting with lower taxes, but you need to book lower profits to achieve the same. This method may not help you in all cases. For example, regular booking of lower profits will impact the investor's confidence. Record keeping is quite complex in most of the cases. Due to too many inventory layers in the LIFO system, this method can make record keeping confusing. This is because the flow of inventory means old layers and older stock can stay in the system for a long time. If you religiously issue latest goods for sale or internal use, older stocks can get outdated or even lose complete value. LIFO is not a method reflecting the real life scenario. You always live with old stock in this model, but organizations want to clear the old stock and run with the latest goods. While GAAP and IFRS accept the LIFO method of valuation, other standards such as IRS have some reservations. IRS allows LIFO if used for all levels of reporting entity as long as the entity is used as a subsidiary. LIFO is prohibited under IFRS and ASPE. However, under the US generally accepted accounting principles, that is GAAP, LIFO is permitted.